I start recording. Sufan, the floor is yours.
Okay. Hello, everyone. Welcome to the Accounting Design Project Workshop. My name is Sufan, and I'm from National Taiwan University. I'm the moderator for the workshop today. And we are happy to have Doron Nissim from Columbia Business School to talk about profitability analysis. Before we start, allow me to repeat a few general rules for the workshop. In the first 5 minutes, please let the presenter present uninterruptedly. And after that, if you have any question or comment, please click the raise hand button in Zoom or type your questions in the chat box, and I will call on you in order. Please mute your microphone when not talking to avoid any potential background noise. And if you feel comfortable, please turn on your camera. And now, without further ado, let's welcome Doron. Doron, the floor is yours.
Thank you. Thank you very much. And thank you for the opportunity to present this work. So, as you all know, profitability analysis is used in many contexts: assessing performance, evaluating earnings quality, risk, forecasting, valuation, and other contexts. So obviously, very important area. What I do in this study is I describe a comprehensive profitability analysis with several innovations compared to other frameworks. So one innovation is the separation and analysis of activities other than operating and financing. Another important one is the measurement of transitory items. And the third one, maybe the most important one, is a new way of decomposing operating profitability. Traditionally, we decompose return on net operating assets or return on invested capital. We decompose it into profit margin and asset turnover. So profit margin, profit relative to revenue. Asset turnover, the way we typically measure it, because we are decomposing return on invested capital or return on net operating assets, we typically measure asset turnover relative to net operating assets. But net operating asset is a problematic denominator because it can be negative, or even when it's positive, it can be close to zero. So it can make asset turnover quite volatile and not necessarily very informative. Also, what generates sales is not the net operating assets. What generates sales is the operating assets. Whether you fund your sales with, whether you fund your operating assets with capital or with operating creditor, with operating credit should not have implications for the ability of the assets to generate sales. So I argue basically that maybe a more relevant way, more correct way to measure turnover is relative to total operating assets, not relative to net operating assets. But if you measure turnover relative to operating assets, not relative to net operating assets, then you have to introduce the third ratio to decompose the return on net operating assets. That third ratio, the third component, I call it operations funding ratio. It's basically the ratio of net operating assets to operating assets, or 1 minus operating liabilities to operating assets. So it's basically what portion of the operating assets are funded with capital as opposed to being funded with operating credit, like accounts payable, accrued expenses, or deferred revenue. So this is the third driver, a third component in this decomposition. And the logic, again, there are several reasons here, and I summarize them on the side here. Again, basically sales being generated by operating assets, not net operating assets. The fact that when you deflate by operating assets, it's a more robust measure to deflate by. And the third element here is that operating liabilities, if you think about operating liabilities, they are more related to operating assets than they are to sales. For example, if you have inventory and you fund this inventory with credit from suppliers, accounts payable will relate to how much inventory you have. So there is an argument to make that maybe measuring or comparing operating liabilities to operating assets rather than to sales, which is effectively what we do when we measure asset turnover relative to net operating assets. Maybe this will yield better insight, both for evaluating profitability, for forecasting, for valuation. So this is the innovation here. Another important innovation is how I decompose, how I measure transitory items, how I decompose special items into recurring versus transitory, based on the nature of the items, based on the behavior of the items over time, and also I do something similar with income taxes. So I describe this operating profitability, or this framework for profitability analysis, and then I evaluate it. Now, this project, the Pepper profitability analysis, is basically a set of 6 interrelated projects. So what I do basically, much of the work is to get reformulated financial statements that are more informative. So this is built much through insight that I learned, for example, consulting with Trevor Harris at Morgan Stanley. We did something similar, but I incorporated here many additional insights and things that I've learned over time and things that came out in academic research and elsewhere. So what I'm trying to achieve here basically is get financial statements that better capture the financial position and the performance of the company. And to do so, basically, an important element is to bring operating leases to the balance sheet. Since 2019, operating leases are on the balance sheet, but when we use academic research, we go back before 2019, obviously. So I have a study where I basically show that you can actually estimate the right of use asset quite precisely based on the old disclosure that we used to have. This requires that you come up with an interest rate, a discount rate, and in a separate study, I can show that you can come up with credit rating for the many companies, most companies, for which we don't have credit rating, use that synthetic credit rating to estimate what the discount rate would have been if they were using the current accounting standard, which is to bring right of use asset to the balance sheet, and then bring the right of use asset to the balance sheet. A separate study, I estimate what would be a tax rate in the absence of transitory income tax effects, like changes in the valuation allowance, or in unrecognized tax benefits, or in the impact of goodwill impairment, and so on. So basically, a separate study where I come up with an estimate for what would be a normal tax rate. This is needed for 2 reasons. One, which is the income tax expense itself includes a transitory item. In fact, a very significant transitory item for many observations. So coming up with an estimate of a normal tax rate allows me to estimate the transitory portion of the income tax expense. I also needed to be able to separate financing and other non-operating activities. So I need to know to also be able to estimate the taxes that relate to those activities. And for this too, I need an estimate of the normal tax rate. Another study looked at the behavior of special items, the different types of special items, which was the basis for the algorithm that I eventually developed to identify transitory items, which I will talk about. Okay, so there's also, in this study of reformulated financial statements, there's also a lot of discussion of pension. And because there are many accounting details and there are many accounting changes over time. So I basically try to be as careful as I can in terms of adjusting the accounting information, making it as useful as possible, and making it more consistent over time. And I hope you download these 6 studies, including the profitability analysis one, and any feedback that any of you is willing to provide would be greatly appreciated. And then I show in the empirical analysis that there is insight benefit to be gained from doing the analysis very carefully and from these additional new drivers of that I identify in this study. So the implications for research and practice. So I mentioned turnover should be measured relative to total, not net operating assets, and I provide evidence to support this. That operating liabilities are more strongly related to operating assets than they are to revenue. Than they are to revenue. And I think, this is seems like a simple insight, but that's not how people forecast, forecast financial statements. I've seen many models in my life, and it's very rare to see people forecasting operating liabilities versus relative to operating assets. Almost everybody does it relative to sales. And actually the relationship between operating liabilities and operating assets is much stronger than the relationship with revenue. So the one inference of this study is that when you forecast operating assets relative to revenue, but forecast operating liabilities not relative to revenue, rather relative to operating assets. And this should give you more accurate forecast. Then I talked about decomposing special items and income taxes into transitory and recurring components. And there will be important insight from this too. Another insight from this study is that, and I actually didn't expect to find it, I was surprised how big was the difference. In accounting research, we always look at persistence, just persistence of ratios. It turns out, and it's correlated, it's clearly very strongly correlated with the stability of the ratios, but it's not a perfect correlation. There are a few very significant exceptions. The one, probably the most important one, is this operations funding ratio. The operation funding ratio, this ratio, is extremely stable over time. It's actually less persistent. It's slightly less persistent than the operating asset turnover, but it's much more stable than the operating asset turnover and any of the other ratios. So the implications from this is that which ratios are stable or not is important, because if I have a ratio that is very stable, when I forecast, just use the most recent level. But if a ratio is not very stable, if it's volatile, maybe you also want to look at past levels of the ratio. Definitely relevant for special items, which is effectively what I'm going to do. And also maybe if a ratio is very volatile, maybe you need to bring more additional information to the table. How stable is the ratio also has important implications for forecasting. So there are insights from these too. So basically I reformulate the income statement, reformulate the balance sheet.
Sorry,
And
Doron?
Yeah.
Sorry, there is a question in the chat box. It's about benefits. Please be specific.
Yeah, I'm going to. I will show you the insight, the empirical evidence. That's where I'm going. Okay, I'll check. So I reformulate the balance sheet, I reformulate the income statement, and then we have these key ratios. Basically, what I have here is a decomposition of return on equity. So there is the effect of non-controlling interest. For most companies, this is not interesting because non-controlling interests are not very significant, but for some they are. And then it's important to examine them because return on common equity and return on equity are going to be quite different in those cases. So most of the time, this branch is not relevant. Sometimes it is. Now I'm going to distinguish between operating financing and other non-operating, like equity method investments, like real estate not used in operations, and other items that will not be part of operations, discontinued operations, for example, will not be part of ongoing operations and not part of financing. And when they are significant, like for example, for Coca-Cola, they have many equity method investments, this branch becomes relevant too. But for most companies, it's not going to be a primary component. So for most companies, these two relevant, but for most companies, not the one you want to spend time on. For most companies, it's these two that you want to emphasize. And obviously financial leverage too, but there is no innovation in my study related to financial leverage. It's just, what has been done before. So I'm not going to talk about this. I'm going to focus on these two. So I think an important contribution of this study is the way that I identify and estimate transitory items, and I have an algorithm for that, and I will show you. And I'll show the result from this analysis suggests that the algorithm works quite well, the empirical results. And then the decomposition that I just talked about, the way you take return on operating assets, and it's not just NOPAT margin, it's not just the turnover, you rather want to look at the relationship between capital and operating assets, and you want to account for this relationship as well. All of these ratios have implications for earnings quality for reasons that I dive into in the monograph, and for risk. But let me focus more on what we want to achieve here before I talk about other motivation. I think the nicest way of motivating it is Warren Buffett in his 2020 shareholders letter. Please read this paragraph. Take a second to read this paragraph, please. He's basically talking exactly in terms of the three ratios. So he's basically telling you, Warren Buffett, that's how I think about valuable businesses. I want businesses that have high asset turnover, minimal assets. I want them to have high profit margin, makes sense. But I also want them to be one where you can grow your asset, where you can grow your revenue, when you can grow your profits without having to commit too much capital. Why? If I can get operating creditors, suppliers, employees, customers, the government through deferred taxes and through deferred payments of income taxes, if I can get credit in my operations, this means I don't need to bring as much capital to invest in the business. And that's another important driver. So he's basically saying, Warren Buffett basically saying, look, what drives values are these three, plus the ability to grow sales. So I think that this quote maps nicely into this decomposition of operating profitability. So I'm going to talk about how exactly I do these things and how I reformulate the balance sheet. But let me start with the motivation for reformulating the financial statements. You know, typically when in reported financial statements, we talk about operating, investing, and financing. For example, in the cash flow statement, we have these three sections. But when it comes to analysis, we typically talk about operating and financing. So we basically take all the investing activities and we say those investing activities that are related to operations should be part of the operating bucket. And those investing activities that are related to financing, effectively undoing financing, should be netted against leverage. Okay? So we basically talk in terms of operating and financing activities, and Jim Olson obviously has many important seminal work on this concept. Sometimes we have items that don't fit these two buckets very nicely, operating or financing, so we need a separate bucket for them, and that's what I'm doing here basically. Again, think about equity method investments and assets and liabilities of discontinued operations as the best example of what you don't want to put into the ongoing operating bucket or into the financing bucket. Now, we want to distinguish between operating and financing because we think about value creation as happening in operations. Still, financing affect profitability because if you have leverage, on average, you will have higher profitability, but not necessarily higher value. And also, we know that the way that we estimate value for financing, we basically go to the balance sheet. For operating, the balance sheet doesn't give us the picture, the true picture, so we need to either use DCF or EBITDA multiples. So this is the underlying motivation for this decomposition. I like to cite Warren Buffett that makes basically these points in his letters, the point that I just made, and they are there in the paper. I'm not going to go through them. We also need to reformulate the financial statements to distinguish what is recurring in the income statement. So for the balance sheet, it's operating versus financing versus other. For the income statement, we have another layer. Before we even go to the operating versus financing, we ask whether an item is recurring or transitory, because we obviously want to focus on recurring items. So for the income statement, and this is typically the most difficult thing to do, to figure out what is transitory in the income statement and focus on the recurring. So if you do a good job identifying transitory, you can then focus on the recurring. What is recurring is not necessarily very easy to estimate. I'll show this quote in a different context later. So you start by identifying on the balance sheet in the asset side these three buckets, on the liability side the three buckets, and we have equity too. We typically assume all assets are operating unless they don't contribute to NOPAT. Then you have to pull them out. If they are financing in nature, you put them into financial assets. Otherwise, you put them into this residual bucket. Okay. That we know how to identify. Everything else is operating liabilities, unless it's really not something that you want to associate with liabilities, or at least not with operations, or at least not with ongoing operation. So then maybe you want to put it into this bucket, like liabilities of discontinued operations or litigation that is truly, truly unusual. Okay. So this is basically, there are several complications here about how to do that, but I think that the big picture, most of us know this, so maybe I don't want to spend too much time on this. So we identify the assets and the liabilities accordingly, and that equity here is defined in a more comprehensive way, basically, including so equity includes non-controlling interest, preferred dividends I basically put into that, and then I come up with a reformulated balance sheet. That the details of this balance sheet are presented in the paper, and in the reformulated financial statements study, I go through into these details and the explanations for why, for example, I put operating list liabilities into the operating liabilities bucket and not the debt bucket, and similarly with pension and other adjustments that I make. Okay. Then once you have the reformulated balance sheet, you basically take operating liabilities to this side, financial assets to the other side, and you get this net presentation of the balance sheet, which shows that the capital funds the net operating assets, but the capital can also fund other items besides operations, like equity method investments, like again, discontinued operations and so on. I always use this framework, by the way, to explain the weighted average cost of capital. I basically said the risk of the operations is the same as the risk of capital. That's why we use the weighted average cost of capital to discount the free cash flows that the operations generate. But then I say, but what if the capital is also funding other assets, not operating assets, not assets that generate free cash flow? Then the weighted average cost of capital reflects the riskiness of those assets too. And that's something that people typically ignore. I think this reformulated balance sheet demonstrates this point. Okay, and then reformulating the income statement. So here we need to distinguish between recurring and transitory items. And we need to allocate the earnings to operating, financing, and this residual bucket of other non-operating activities. The most difficult part are estimating transitory items and estimating and allocating income taxes to what is transitory, operating, financing, and other non-operating. As I mentioned earlier on, this requires that you have an estimate for what would be a normal tax rate so that you can measure the transitory component of the income tax expense. So this is the reported income statement, and this is the reformulated income statement. So top line is basically the top line. Bottom line is the bottom line. The most difficult part, again, is to estimate what you're going to put into this transitory items bucket. And for this, I have an algorithm that I developed in that study, reformulated financial statements, based on insights from the study that looks at special items that I will explain. And this one also includes the abnormal portion of the income tax expense. And we need to allocate income taxes also to these two other components. The algorithm that I use for estimating transitory items basically takes you through the following steps. So I basically said there are 6 types of components that you have to consider as transitory. So you have volatile, and I will explain each of them. Volatile non-operating income, transitory operating income. Then for most items that we typically treat as transitory, like restructuring, impairment, and so on, most of these items, I argue basically, these are really volatile items. They're not, the way to label them is volatile item, not transitory item. I think Warren Buffett makes this point very nicely in this quote. So maybe, for example, so I think this is the key point here, that what companies identify or suggest is transitory is not really transitory. It's volatile. Now, it's true. The most recent value can be much more than what we have on average, or much less than what we have on average. So you don't necessarily want to take the most recent value and say, this is the value from which I'm going to extrapolate. But you also don't want to completely ignore it. Restructuring is always negative. So yes, it's not a regular item, but it's always negative when we have it. Impairment is also always negative when we have it. So these items are volatile, they're not transitory. And most of the items that we have in special items are fit this description. So basically what I say is the following. I say, for some items, you may be able to argue that you want to treat them as transitory. Like, for example, gains or losses from sale of investments. Why? Because in any given year, they can be positive or negative. And in expectations, they are close to zero. They're also not related to operations. So you probably want to, yes, treat them as transitory. Now, sometimes you may be able to come up with items that we have in operating income that you may be able to argue this is really a one-time effect. But I would argue that most operating items, you want to put them into this bucket. And only if you can make a very convincing argument, then pull them out and treat them as completely transitory. Most of them, what you want to do is you want to smooth them over time. You want to measure how much of it is recurring and how much of it is transitory. And with income, and then you want to measure income taxes on them and abnormal income taxes, and then the amounts that are reported below income tax expense.
Excuse me,
Yeah.
Doron,
Yeah.
Ayo has a question.
Yeah, please.
Hi, Doron. Related to this transitory versus recurring, my question is, how do we define the normal period for a normal set of firms? So earlier this session, Patty Bichel had a paper about transitory items, and then usually academic research is doing something at a very high level. So by line items, we are going to assume some line items will be transitory for all the firms in the economy, some other items. But I think your approach here seems to be finer, which is can be firm specific or period specific. But I want to hear about how do you define
so this is
5
basically
years or 10 years to specify.
So this is basically the algorithm that I use. I basically say estimate the normal level of these items, impairment, restructuring, and so on. How do I estimate it? I basically look up to 10 years back. So I require a minimum of 3 years back, but I look back up to 10 years. But I put more weight, bigger weight on the more recent values than all the past. So like 10 years ago gets very little weight in the calculation. The last year gets quite a lot of weight. Okay. I also don't calculate the weighted average of the ratio. I calculate the weighted average of the numerator and the weighted average of the denominator. The weighted sum, I should say. The weighted sum of the numerator and the weighted sum of the same as the weighted average. Why am I doing it this way? So there are several reasons for that. We know that these items like restructuring, impairment, and so on, they have irregular pattern. So you can have an impairment loss or a restructuring charge for 1 year, and then 2 or 3 years, you're not going to have anything. We also know that these items are correlated with what is going on. For example, at times when the economy is not doing well, there will be much more impairment, there will be much more restructuring. So these two imply that you need to use a relatively long period of time. Also, if you do that mechanically, you will see that if you have a relatively short period, then the change in this period, the adding of 1 year and the subtraction of the previous year, can give you a lot of bumps in this ratio. And this can basically makes this less informative. So for these three reasons, I basically say you want to have a relatively long history that captures the full business cycle, account for the irregular pattern, and again, get rid of this bump effect that I just mentioned, that empirically actually is a big deal if you don't get rid of it, if you do it over a short period. Then I said, you want to also have a relatively long period because you want to capture the distortions that we argue are going on here. Impairment is because you didn't depreciate enough in prior years. Impairment is going to affect future depreciation. Restructuring is because you didn't expense enough in the past, or maybe it's going to benefit you in the future. So you want to have a relatively long period to basically improve the matching that impairment and restructuring are distorting. So this is another motivation. Then the weights go back, decline, because you can argue, and actually in the special item study, I provide evidence that the more recent past is more relevant. So the history is relevant, but the most recent part is more relevant. And then then you want to weight it by sales, because if you are a very small company where you had an impairment loss and it was a tiny one, and now you are a bigger company, you don't want to give a full weight to the time that you were relatively small. So this calculation actually allows me to weight both by the time, how recent the evidence is, and by sales, because I calculate the weighted average of the numerator and denominator as opposed to the weighted average of the ratio. Okay? So basically, this is the algorithm that I do. And actually, empirically, it does provide much better results than if you just look at total special items, or you do a simple smoothing, or you use a relatively small average. So this is an algorithm that basically try from the nature of the item, because I'm not doing the smoothing for everybody, all the items. There are 9 types of items that CompuStat identifies. 9 types of items. So goodwill impairment is not common, only 11% of the time. But when you have it, it's huge. It's huge when you have it. So in terms of economic significance, this is the most significant one. Restructuring charges is by far the most common one, and it's quite significant. Asset write-down is also quite significant. So these are the 3 that are the most significant one. M&A cost. Yeah.
Sorry to interrupt you. Ayong, you want to ask a question?
No, I think, Doron, you can finish this slide, yeah.
Yeah. So these are the different items that we have. In this study, I basically look at the way that these things behave and their implications for future pre-tax margin, pre-special items margin, and implications that are correlated to. Basically, after a lot of analysis, and I hope you will take a look at this study, a lot of analysis, I reached the conclusion that probably the way that you want to do it is as follows. You want, in this, the bucket that you don't smooth is gains and losses on asset sales and gains and losses on extinguishment of debt. This you should treat as transitory. CompuStat does not allow you to identify items, operating items that are truly transitory. Now you can argue that there are some operating items that are truly transitory, but again, if CompuStat provided the information, I would treat them as such. Actually, with XBRL, many of these items can be identified. So maybe XBRL would allow you to be more careful in terms of how you define transitory operating items. Here again, I assume 0 because I'm using CompuStat. Everything else falls into this bucket that I'm doing the smoothing, and that's how I'm doing the smoothing as I just described.
So Doron, I have a follow-up question. When you say 10 years, and then we know like in recent 20 years, a lot of firms are only listed for a few years and then delisted. So they have very short history. And earlier you talked about you have a synthetic credit rating method for firms that are not rated. So can we also use something similar here? So think about like OpenAI is more like Apple or Microsoft 30 years ago, and then somehow we try to use established firms' life cycle to kind of like come up with an estimate for a younger firm.
Yeah, you can. Yeah, sounds like something. But there are idiosyncratic effects. Companies, even in the same industries, you can have some companies that will do a lot of restructuring, a lot of impairment, and others that will not, and will just view this as part of their operating expenses. So you can do some inference from other companies, but again, there's always the idiosyncratic effect that will not be captured. And here I'm only using idiosyncratic firm information, firm level information for this. Okay, so now I have all these components, and I know how to measure transitory items, and basically I reformulate the income statement. And maybe I will show you some evidence on this decomposition. So this is basically with the way of, maybe so one thing that I should have mentioned, it's not just special items. Another very important component in terms of transitory items is the income tax expense. So the way I calculate the abnormal income taxes, this component is actually quite significant and quite, this component is quite significant. Yeah. I see Jim is asking here in the chat. I didn't look at questions before. So if I'm claiming that I can forecast better than analysts, Richard Sloan has a study now that actually uses my algorithm. He compares my algorithm to other algorithms, and he actually finds very nice results for my algorithm. So there is actually, besides my study, there is another study by Richard Sloan that does find that this algorithm actually performs quite well. Then I have other questions here. So, let's see. Just a comment. Okay.
Yeah, I mean, if I may add on, it's a question of us who are listening to understand that there's a purpose to what you're doing. And you're putting up a lot of ratios and ratios connect, no question. We all know that. The question at hand is that we have to accomplish something. And I don't want to ask you if this is the road to riches, because that raises too many issues. But it would be useful if you pinpointed what is it that analysts are missing out on when they forecast sales and margins? What is it that they are not doing that you are doing that gives you an edge? That is really what we want to know. So it could be, for example, that you're saying, if you really want to improve your forecast of earnings and margin, it really helps to understand special items in the following way. That is sort of an operative way of proceeding. And that's very different from sort of just doing mechanical statistics or running regression models and so forth.
The motivation is definitely what you said. The motivation.
Yeah. So that's sort of because we want to know, at least I'm talking about myself. I would like to know where we're heading. Where are we heading? I teach FSA. What is it that I can teach that gives my students an understanding and an edge?
Yeah, I can actually tell you that I implemented it with
Yeah. But I'm saying
very large institutional investors. That's basically how the portfolio managers.
No, I mean, yeah, I'm sure. I mean,
estimating this thing. So this is based on something implemented.
Yeah, all power to you, roads to riches. I'm just giving you some feedback as to when I'm listening to what you're doing and when I'm reading your paper.
No,
over and over, I ask myself, where are we heading? Where are the benefits?
Yeah. So
And
good question.
From that point of view, it's well to note, for better or worse, so to speak, that return on common equity is not much discussed in practice for very good reasons, because it's not a performance measure.
Yeah.
So that's sort of, in some sense, the starting point is that in textbooks and naively, we start with return on common equity. That does not work, however, because it's not the measure of economic profitability, and it doesn't really connect with what we want to do. So that's sort of, then you lay out all of these things can do, and a very large number of ratios to be calculated, and we can go on and on and on and on. But from our point of view, in some sense, what we want to do is to start from the end. This is what we're trying to accomplish. And if this is what we're trying to accomplish, these are the ratios we want to deal with.
Yeah.
So end of my talk.
No, very good. So it's basically about forecasting margins. How do you?
Yeah, I mean, that sort of would be helpful to know here, that I was going to ask you, for example, how does this help me to forecast growth in sales? That's very, very, very important in practice.
Growth in sales is the operating asset part.
No, but either you can deal with that question or you cannot deal with that question. I'm fine with both. But I would like to know, is this something that's lurking in the background? Then bring it forward. Can you use your analysis to better forecast growth in sales?
So I believe I provide evidence here that show, most importantly, that you can better forecast the margin. Because what we typically do.
All right, so now we're getting down to that.
Yeah.
All right, that's helpful.
So
now
for
that's,
example,
of course, in the real world, that's much, much less important than forecasting the growth of sales.
I'm not sure I agree. I'm not sure I agree, because the way that people forecast sales is typically not based on financial statements.
Okay. We don't argue about that, but many people believe that forecasting the growth in sales is far more important than forecasting the changes in margins, okay? In general. But my point is really not to tell you how the ratios are good and bad and what we can do. My point is that it would really help us if you dealt with, here are the benefits you're going to get out of this kind of analysis.
Yeah, so that's exactly where I'm going. Basically,
All right, okay.
instead of treating special items, all special items as transitory items, if you do that, then the properties of the ratios and therefore your ability to forecast is going to be affected by that. The quality of the forecast is going to be lower, both in terms of bias and in terms of the precision of the forecast. But if instead you basically look at the different items that we have, and some of them treat as transitory and others don't ignore, but rather smooth them over time, and in a particular way that I suggest you, it will basically give you a much better sense what portion of the profitability is actually recurring and what portion is transitory. And obviously we care to know what portion of the profitability is recurring, because when it's about predicting the future, it's about evaluating what is recurring and what is not. So that's where I'm going with this. This is for the margin. For the revenue one, for the revenue part one, there are several things that show how to basically better forecast revenue. But for example, you want to think about operating assets as generating revenue, not as net operating assets, which is effectively what we do when we measure turnover relative to net operating assets. So you want to measure turnover relative to operating assets, and this will give you more precise predictions. And I have evidence in the study to show
that's
that
sort
too.
of a strong statement. It gives you more precise predictions. More precise than what?
Then measuring it relative to net operating assets. Also,
Okay. But somewhere along the line, one could argue that you set up a straw man. I can forecast better than X. If X is, nobody would do it that way in the real world. What you really want to do is to make the claim that if you follow my way of doing the analysis, you will beat analysts.
So for the margin one, I'm quite confident I can make this statement for the reason that I know from interactions with many analysts and many portfolio managers that typically what they do with these things is they follow management. They exclude them, they ignore them, and then they have a measure of profitability which overstates true profitability by a lot. And the problem is that it does it in a way that is not consistent across companies, because some companies will have special items, others will not, for a very similar business. And so the point is that you do want to be able to divide what portion is recurring and what portion is transitory. And I think that's an important part of this analysis. Also, we tend to think about special items. We don't look that much at the income tax expense. It turns out that the income tax expense itself includes a lot of transitory items. And you can relatively, in a simple way, estimate, also based on essentially the time series behavior, and also looking at the effective tax rate in relation to the statutory tax rate. You can estimate what would be a normal tax rate, and therefore the extent to which the income tax expense this year was different from the normal level. And so now you have an ability to forecast this component too. When you estimate transitory items this way, then you get a measure of transitory item that behaves in a much more reasonable way. Now, transitory items, when you follow this algorithm, as mean zero, as you would expect it to have, median zero, also as you expect it to have. Once you remove the transitory items from the ROE, the recurring ROE that you have left is much less volatile. It's much less squeeness, so it's much more symmetric. So these are all nice statistical properties that help you, help you predict what these ratios are going to be in the future. So this, again, indication that this way of identifying transitory items work well. I also show you that when you look at the persistence coefficient, transitory ROE, the way that I estimate it, is not completely transitory, but it behaves within 2 or 3 years, it becomes really transitory. No persistence anymore. Still some persistence initially, so I'm not able to completely identify all the transitory component using my algorithm, but apparently I do a reasonable job. And again, once you remove transitory items, the recurring ROE becomes much more persistent than the total ROE. So this is again another indication that this algorithm for identifying transitory items work well. Similarly, with the coefficient of variation, the transitory ROE, as you would expect, is very volatile relative to its mean. So that's what you expect from transitory items. And once you remove transitory items, the coefficient of variation, the variability over time in the ROE, once you remove transitory items, become much, much smaller. So the coefficient of variation improves a lot. And then when we show in a regression analysis that in sample, you show that that basically after the first year, the coefficient on transitory ROE becomes close to 0, and the ROE and the recurring ROE, the coefficient is obviously much, much higher. So this again, another indication that this algorithm works well in identifying transitory items. Out of sample, very much so. So this is purely out of sample, and you see both big improvements in median error, big improvement in the mean error. So the improvement is not just in the center of the distribution, which is what you get from the median. The improvement is also in the extreme, because you get similar picture with the mean. So basically what I'm doing here is out of sample, predicting best either on ROE or the two components of ROE. And even in this very simple linear regression setting, you find huge improvements. Yes, Ken.
Well, just a short question here. I mean, I guess that we all have our ideas of how to dichotomize accounting ratios, and we do it in all kinds of different ways. But kind of linking up here to Jim's question, at the end of the day, we want to be able to use it for some purpose. So have you some indications of whether these ways of calculating ratios would be helpful, for example, in equity valuation, would lead us to lower errors if we do some kind of application of standard type RIV or PV, the evaluation models? So we see that there is something to gain from it. Another way of approaching it would be to say that given this, you can get more signals from the accounting ratios. So you could do some principal component analysis to see whether there are more available information in this way of kind of designing the data. So I think that it would be interesting not just to look at means and standard deviations. It's no surprise that if you do something of taking out these transitory items, they will become more stable. But we would like to see some kind of benefit in some type of real world important context, like equity valuation, bankruptcy prediction, or something like that.
Yeah, good. So you basically, I'm getting to the question of forecasting, whether it improves the forecasting accuracy. So just dividing ROE into recurring and transitory, even in this very simple linear regression setting, gives you big improvement in out-of-sample prediction. And it's much, much bigger improvement that you get if you separate just special items, as is commonly done in the literature. So here in this study, because it's already quite long, I just tried to develop the framework. And I think that you are correct. There has to be, and Jim is correct too, there should be much more follow-up work on this to show that there is really a huge benefit, if, from this, or significant benefit from this. I think the kind of work that Oliver is doing, and in diving deeper and using more sophisticated statistical methods of extrapolating information, getting information out of it, is definitely something that is relevant and should be done. I'm trying to stay more basic here and just suggest ratios that, or relationship and adjustments that I think would allow you, like you said, to build on it. It's not I didn't take you all the way to the end result. I just started, I think, here. There is much more that has to be done. Yeah, but I think this is already shows that there is promise in it, because even in a simple linear regression, non-contextual setting, you can get significant improvement. Then maybe it's promising that there is even more potential once you allow for more contextual and more sophisticated ways of extracting information. And here specifically, I'm talking about forecasting. And forecasting is relevant also, obviously, for many, many things, valuation and many other reasons. So this is the results from the recurring versus transitory. I don't have much time left, so I will go to the operating profitability one. So I'm basically introducing a new ratio, and I'm arguing that there is potential information in this new ratio. So to prove this, that there is indeed potential insight from using this ratio and the set of 3 ratios, the way I'm doing it is I'm doing it in several ways. So one way, I basically made a point that sales is more strongly related to sales than it is to, that sales is more strongly related to operating assets than to net operating assets. and I will show you evidence for this. I made the point that operating liabilities are more strongly related to operating assets than they are to sales, and I will show you this. And you know, I think you can argue that people don't predict sales based on operating assets, what Jim said earlier on, and I can understand it. Most people don't spend too much time with the balance sheet. Most analysts, most portfolio managers don't spend too much time with the balance sheet. But for the second bullet point, I can tell you based on reviewing thousands of models in my life, thousands of models, almost everybody predict operating liabilities. Analysts, portfolio managers predict operating liabilities based on sales, not based on operating assets. Very, very, very few people would think about accounts payable in relation to inventory, or in general, operating liabilities in relation to operating assets. I show you evidence that there is a much stronger relationship between operating liabilities and operating assets than there is between operating liabilities and sales. So this is, I think, one insight that you can immediately take to the way that people do forecasting and valuation. And I think this study provides convincing evidence, and you can dive deeper into it, obviously. And then another result that I didn't expect, which is the difference between the persistence result and stability, the result that I mentioned earlier on. And then we'll look at the out of sample improvements from this. So here, basically, I want to compare which one better predicts sales, which one has stronger association, operating assets with sales or net operating assets with sales. So I basically look each industry each year. So I look at the average relationship of sales to operating assets versus sales to net operating assets. And I compare for each company the forecasted sales based on operating assets versus based on net operating asset. And you see that there is a huge improvement in the huge reduction in the error when you base this on the relationship of sales to operating assets versus sales to net operating assets, both in the median and in the mean. And they're very highly significant. The same result when you look at the relationship over time for the company. So clearly, you don't want to measure turnover relative to net operating assets. You want to measure it relative to operating assets. So this is the result from you. This is the same analysis with respect to operating liabilities, whether operating liabilities are more strongly related to sales or more strongly related to operating assets. And again, the result is very clear, both in the median and in the mean. The relationship between operating liabilities and operating asset is much stronger than the relationship of operating liabilities with sales. Again, immediate implication, don't forecast operating liabilities based on sales. Forecast them based on operating assets. Then,
Sorry, we got a question in the chat
Yeah.
from James.
Why are return on equities important, assuming there are no transitory items? So, if you want to talk about, I'm not doing financial institutions here, but obviously, for financial institutions, it's about ROE. So that's basically what they focus on. Most other companies outside the financial sector, the ROE itself is not that relevant. But my point here is about removing transitory items. And by the way, and you are asking a good question. Everything that I did here, I also did, instead of looking at transit, and I should add it to the paper, I should mention it. Instead of looking at transitory items relative to equity, which is transitory ROE, I did the same thing with relative to sales. And the results are very similar. So I understand your concern that when you analyze companies outside of the financial sector, ROE is not a construct you pay much attention to. I agree. But my point in that portion of the analysis is really the identification of transitory items. I used equity because it's, nice framework. Same results I get when I deflate by sales instead of by equity. And here you see that operation funding ratio is significant for many. So if there are no operating liabilities, this will be 1. Because then net operating asset will be the same as operating assets. When you do have operating liabilities, they will be less than 1. On average, it means basically that the operating assets, on average, only 2/3 of the operating assets is funded with capital. 1/3 of the operating assets is funded with operating credit, accounts payable, accrued compensation, deferred revenue, and so on. But there is a lot of variation. This means that deflating by net operating assets, you're basically ignoring all this variability. These two drivers are more persistent than operating profit margin. We know that asset turnover is more persistent than operating profit margin. The two components, actually, the turnover and the funding ratio, have very similar persistence. So if you just look at persistence, you will say to yourself, what am I getting from decomposing the total asset turnover? Actually, you gain a lot, because the stability of the operations funding ratio is twice as high. The variability is half the variability of the operating asset turnover. So the operations funding ratio is extremely stable. So basically what it tells you is the following. When you forecast, you need to forecast revenue growth, very difficult and mostly not based on the financial statements. You need to forecast the EBIT margin. If you do a good job removing transitory item, the historical EBIT margin will tell you quite a lot. But in any case, you're still going to bring quite a lot to the table to forecast where the EBIT margin is going from here. The income tax expense, I have something about the tax, how to forecast the tax. Then come the investment in operations. Most people think about capital expenditures and investment in working capital. Here, I think it's in terms of operating assets and operating liabilities. You want to forecast what these results basically tell you, and very clearly so, is that you want to forecast operating assets in relation to revenue, and you want to forecast operating liabilities in relation to operating assets. And when you forecast operating liabilities in relation to operating assets, the most recent ratio is basically all that you need. Just take the operations funding ratio and assume the same thing in the future. For the operating asset turnover, you probably need to think more carefully about it. The past gives you 75% of what you want, but you can still bring something to the table in terms of where the operating asset turnover is going from here. So I think this is a nice insight, I think, that comes out of this analysis. When I evaluate the results here, again, the operations funding ratio behaves very differently from the operating asset turnover. And I don't want to spend time on it, but because I'm done with the time. But out of sample predictions, simple linear regression doesn't give you the same nice results that I got for the transitory one. It clearly, decomposing into the three drivers, clearly helps you in terms of extreme errors. It helps you a lot in terms of extreme errors, because there is a big reduction in the mean squared error, but not in the median. Not in the median. So I think this is where more sophisticated approaches than simply linear regressions may help, and maybe making it more contextual. But it clearly, even in a linear, simple linear model, you get much improvement in the extreme errors. So this is basically the story of what I'm trying to do. Again, there is much more in this set of papers that I have here, and I hope you will find them interesting to read, and any feedback that you would like to provide. If there are any questions.
All right.
I
so
have a quick question. It would be useful if you provided a narrative as to why these regression models are relevant. And it's not quite clear from the paper, and I was wondering if you could give a short few sentences to motivate this is why my regressions are interesting.
No, I think that the motivation here is that even in a simple regression setting, non-contextual linear regression, it appears that this decomposition does give you some insight, definitely for the transitory versus recurring, and also, at least at the extreme, for the three drivers of operating profitability. The point, and that's basically how I summarize it, that this is just suggestive evidence that clearly you need to do something more, much more contextual, more better methods than simple regression to extract all that you can extract from it. And I have some discussion of this in the paper. I think the kind of work that Oliver is doing, is basically trying to take it to that next step. which I'm not trying to do in this study. I'm just trying to lay out a framework here.
Okay,
All right, our time is up. Doron, do you want to show the last slide before we?
Oh, yeah, I forgot about it. Yeah, you know, I promised to give the last slide, yeah. Sorry. The call for
This-
paper.
Yeah, we will send out. So thank you, everyone, and I'm gonna stop recording.